All right, let's dive into this really fascinating world where high finance meets high-powered computing. We're going to pull apart the engine that drives modern markets, automated trading.
This is the multi-trillion-dollar question, isn't it? Can an algorithm, just a piece of code, consistently find profitable patterns that we humans miss? Well, that is the entire premise behind a field we call quantitative trading, or quant trading for short.
Now, you'd probably think the secret sauce here is some mind-bendingly complex math, but check out this quote from Dr. Ernest Chan. He's a physicist from Cornell who became a quant trader on Wall Street. Even with a background like that, he learned a really hard lesson. More complexity doesn't equal more profit. Actually, a lot of the time, it means the exact opposite. And that little nugget of wisdom really sets the stage for everything we're about to talk about.
So if it's not some magical, super complex formula, what do quants actually use? Well, the answer is often surprisingly simple. They rely on a toolkit of statistical indicators, and each one is designed to ask a really basic question about what the market is doing right now.
Okay, so the first question you might ask is, has the price moved too far, too fast? That's exactly what the RSI, or Relative Strength Index, is for. Think of it like a speed gauge for a stock. It tells an algorithm if an asset is overbought, meaning it might be due for a pullback, or if it's oversold and maybe, just maybe, ready for a bounce.
Another great question to ask is the price doing something weird, something unusual? And for that, you've got Bollinger Bands. What they do is create this dynamic channel around the price. So when the price suddenly breaks outside of that channel, that's a statistical outlier. It's a huge flag for the algorithm, signaling that something out of the ordinary is going down.
And finally, there's this crucial question. Which way is the herd moving and how fast is it going? Well, that's the job of the MACD. By comparing the short-term momentum to the longer-term trend, it helps a model figure out not just the direction of the market, but the strength and the conviction behind that move.
Okay, so how do these tools actually come together in the real world? Let's take a look at a really interesting case study where researchers applied these exact indicators to the wild, wild west of cryptocurrencies.
So these researchers took data for Bitcoin, Ethereum, and a bunch of other big coins from late 2018 to late 2021. Then they trained a type of machine learning model called a bagged tree, which is basically a clever way of combining lots of simple predictive models to make one that's way more robust. They wanted to see how well these classic indicators could predict a buy signal. And honestly, the results were pretty stunning.
The results were impressive across the board, but one number just jumped off the page. The model that used only the RSI signal, it achieved 100% accuracy on the historical data. I mean, not 99%, perfect. It never missed a single buy signal in the entire dataset.
So a model with a 100% hit rate? I mean, that sounds like a license to print money, right? But this, right here, is the exact moment where so many aspiring quants hit a massive, massive wall. It's what we call the backtest illusion. And it's this huge counterintuitive truth at the heart of this whole field.
So the simple, direct answer is no, not at all. And the reason why is that a strategy that looks absolutely perfect on past data, what we call a backtest, can, and very often does, fail spectacularly when you try to use it in the real live market. Let me show you why.
The first trap is something called survivorship bias. It's what happens when your historical data only includes the winners. You're testing your amazing strategy on all the stocks that survived, but you're completely ignoring all the data from the companies that went bankrupt, got delisted, and just vanished.
And this just illustrates the danger perfectly. One study showed a trading strategy that made a massive 388% gain when it was tested on a database that was full of survivorship bias. But when you account for all the stocks that went bust, that same strategy would have actually lost 42%. I mean, that's a catastrophic difference.
The second trap is even sneakier. It's called data snooping. The best way to think about this is like you're torturing the data until it confesses to something. If you test thousands and thousands of different rule combinations on the same set of historical data, you are absolutely bound to find one that looks amazing just by pure random chance. You haven't found a real, repeatable pattern. You've just perfectly molded your strategy to fit historical noise.
Which brings us right back to Dr. Chan's wisdom. The crucial point is this. A model with dozens of finely tuned parameters is incredibly fragile. It's been over-optimized for a past that is never going to repeat itself in exactly the same way.
The simple, robust models are often the only ones that actually have a chance of surviving out in the real world. But okay, let's say you do everything right. You avoid all those traps. You build a simple, robust model that's totally free of bias. You're still not safe. And why is that? Because the market itself can just change the rules of the game on you without any warning.
Markets go through what are called regime shifts. This is a fundamental change in how the market behaves. I mean, think about the 2008 financial crisis, or more recently, the meme stock craze of 2021, where armies of retail traders basically threw all the old models right out the window. All of a sudden, the very patterns your model was built to find, they just vanish.
And what's even worse is the risk of contagion. You see, a lot of these huge quant funds often use very similar strategies. So when one big fund gets into trouble and is forced to sell off its assets, that drives down prices, which then triggers losses at other funds that are using the same strategy, forcing them to sell, creating this vicious, self-reinforcing domino effect that could just cascade across the entire market.
So we've got these simple tools that can seem perfect on paper, but are often built on illusions and can be completely wiped out by sudden shifts in the market. So what does all this mean for the future of automated trading? Well, the answer might surprise you.
The reality is, successful quantitative trading isn't about finding some magical secret formula. It's a game of rigorous testing, of having a deep skepticism of your own results, and an absolute obsession with managing risk. A perfect backtest shouldn't make you excited, it should make you suspicious. And you always have to remember that the real world can and will eventually break your model.
Which leaves us with one final provocative thought. In a world that's increasingly run by algorithms, the biggest challenge isn't just building the perfect bot, it's the human paradox. It's having the discipline to actually follow the model when your gut is screaming no, but also having the wisdom to know when that model is broken and it's time to pull the plug. Because ultimately, the code is just a tool. The hardest decisions, they still fall on us.